Okay, so thank you for that intro. I think that sets the stage and the topic of our conversation today. Ultimately, we're going to be discussing where we are with tokenization. And I think it's quite clear that we're in a pretty good, strong place with the topic and the category, tokenization in itself. Right now, there's roughly about 30 billion real-world assets on chain. Citi recently reported that they're forecasting 5.5 trillion by 2030. There'll be potentially 1.9 trillion stablecoins also in 2030. So all things are pointing in a upward direction in this category. And I would say that is very much anchored by much of the regulatory support that's been taking place in the last year. So with Genius providing clarity on how a stablecoin can be launched and be compliant and regulated. And then with the Clarity Act, which is moving through legislation, essentially outlining how market structure exists on chain. So that, despite the markets, the crypto markets being quite down today, there are some bright spots in our space. So to kick it off, I'd love to do some quick intros. I think all of the companies represented are very well known. So instead of explaining what your company does, we'll just quickly go through what each of you are focused on and the problem you're ultimately trying to solve. Monet?
Hey all, I'm Monet Supply from Spark, and I'm primarily focused on helping our partner stablecoins and tokenized assets achieve utility and liquidity on chain, and then also standing up some more institutional lending and collateral management businesses.
Hey, I'm Simon from Superstate. I talk to asset managers and companies looking to IPO or access capital markets on chain, and we make it the most efficient and enjoyable experience we can.
Hello, I'm Otto Nino from DTCC. I'm the Embedded Risk Management Director for Digital Assets. And I'm mainly focused in introducing and overseeing the introduction of and adoption of new risk controls as we adopt the DLT technologies.
I'm Jasmine Jia, Head of Tokenization Ecosystem at Fidelity Digital Asset Management. I'm the asset manager of this group. So our group focused on adding crypto to accessible fund structures such as exchange traded product structure for easily accessible to treat cryptocurrency as an investment asset. On the other side, we take investment funds on chain for additional utility. So that's part of the mandate that I focus on full time. I focus on product strategy, go to market, solving use cases, and figuring out the narrative of investments and utility. And then we are eventually excited to see how we can build native investment portfolios on chain in the far future.
Awesome. That sounds like you are quite busy. Simon, let's talk a little bit about Superstate and specifically where you guys are focused now, because initially the product you were building was really kind of focused on the actual management of the assets that you were tokenizing. And more recently, you've kind of shifted into just purely being the infrastructure for that and passing the management on to partners such as Invesco and Bitwise.
Yeah, that's a great question. Thank you. I think we started about 3 years ago with a view to saying traditional assets can also be on chain and we can add utility to the holders and the issuers, right? So whatever that might mean, it might be the ability to borrow or lend against an asset in Camino or Ave Horizon, or it might be good for the issuers to have more transparency into who holds their assets and how often they trade it. So that was the kind of idea. We decided to stand up 2 funds ourselves just because it was easier to do that than go to an asset manager with an unproven product. So we started a T-bill fund, and we started what's USCC, which is a crypto carry trading fund where you trade the basis versus CME and spot. We got those 2 up to about 1.3 billion under management with about 300 institutional clients and integrated them across Solana and Ethereum and Bloom and now Base. But we were never an asset manager. That wasn't our goal. Our goal was to be a technology layer and be a regulatory umbrella for any asset manager who wanted to bring their assets on chain. So hence the launch of FundOS. So we said, okay, well, we're going to pass over this $1 billion fund to Invesco. They're using our rails. They're using our technology. They're using our transfer license. Great. We passed over our basis trading fund to Bitwise, which is great. We've just announced Coinbase Asset Management is using our platform. So we're over half engineers. So I'm in the minority, not being an engineer and not being that smart. So those guys are doing all the work, and that's the service that we're offering. And it's kind of the service we were always getting to. And that's where we see our scalable business. And then we have the equities side where we're taking public equities and natively issuing them on-chain. And natively is an important word because we can compare and contrast that to the wrapper model. We're very much natively issued in clear light aside of the regulator, working with the SEC on every step of the way, distributable onshore in the US, unlike a lot of the other products, and we can take any equity, we can take any fund, any ETF in future, there's a little nuance around that, and put them on chain within a couple of weeks. That's our superpower, not managing T-bills, which is what Fidelity do super well.
Awesome. So with that, you're essentially able to kind of take care of the bringing to life any type of financial asset and make it usable on chain, tokenizing it in a wrapper form. Where do you find the bottleneck when it comes to the cash leg? And what is, in your opinion, the best format of a cash leg?
Yeah, so I think it's a good question. So I think I'll take a step back. I think when you've done a wrapper or a natively issued asset and brought on chain, you're a long way there. You've done like a good number of miles in the marathon. Probably the last stage is why we believe natively issued is better than a wrapper form, because a wrapper form gates that last stage of primary minting and redemption, unlike anything that's natively issued on chain. A wrapper and natively issued is great because it's 24/7 trading, it's DeFi integrated, it's all the cool stuff you can do in addition to traditional markets. You're adding on utility, you're adding on distribution, you're adding on all that kind of cool stuff. But a wrapper still is at the behest of traditional market structure, which comes down to timing, it comes down to Fed-wired timing as well, and it comes back to all that kind of stuff. If you want to go in and out of a fund, for example, with Fidelity, if it's a wrapper system, you've got to wait till Fidelity's functioning again or the markets are open, you can do that. And natively issued equity can, or equity or asset can happen 24/7, 365. Our T-bill fund is 95% in US government debt. It has a NAV that ticks up by the second, so you earn interest every second you're in that fund. And you can redeem out of it. You can go into it on a Saturday morning, come out of it on a Sunday afternoon, and earn a day and a half's interest in US government debt when the market's been closed and all the banks are shut. And that's a huge implications for intraday repo, for interest payments, for velocity of money, for balance sheet requirements and everything else by that. So add whatever asset you want in that, and we're away.
Okay. Monet, so coming from the lending side and also having, your own stablecoin product embedded within it, talk to me about your opinions on what is the best cash leg. So in the choice of a stablecoin, a tokenized deposit, and a tokenized money market fund, are there pros and cons with any of those? Do they all do fine just as they are, or should one potentially be the dominant cash leg?
Yeah, that's a great question. I kind of view them as like two main use cases. So I would say that stablecoins and tokenized deposits are quite similar in the form factor. They provide very high liquidity, but the economics being passed through by the issuer typically are a bit less. Versus a tokenized money market fund, the economic pass-through is a lot better, but the liquidity and sort of like on-chain usability, being able to get in and out, is not as strong. From our perspective, we pulled billions of dollars of stablecoins, and in the past we've held over $1 billion of tokenized money market funds. We have a pretty strong preference for stablecoins over tokenized deposits. Tokenized deposits, they're still kind of like in an earlier stage of development, but they don't have the level of on-chain acceptance, of broad sort of like network effects and support by different centralized exchanges and service providers. So that's a major gap. And then beyond that, there's also a, in some sense, like an elevated risk that we face if we're holding, basically bank deposit exposure that's exceeding FDIC limits. Then suddenly we can find ourselves in a situation like back in 2023 when Silicon Valley Bank had almost a blow up. USDC was at like a pretty high risk of insolvency there, which could have flown through into our products. So, tokenized deposits, I think public policy makers, they view it as potentially like a positive that it can keep more funds in the banking system, help facilitate credit creation like banking has worked until now. But, if we were to hold a tokenized deposit on our balance sheet, we'd probably only be willing to face like a globally systemically important bank, someone who has like an implicit government guarantee. So it's not clear whether that's actually like really fulfilling any public policy goals if we're just siphoning more money into a very small list of already, major banks.
Okay, that's a very interesting point, and kind of looking at it from like where you are a crypto native, on-chain native, DeFi native, pick whichever word sounds best today. I keep changing it depending on the perception in the market. Yeah. And I think this is an interesting point because on the panel you have two companies that are have been built from the traditional finance world. DTCC, Fidelity, Superstate, and Spark have been built up from a crypto native place. And so, Monet, what you're saying partially is that looking at a cash leg, candidate, the risk calculus is actually being put on traditional banking, right? There's some limitations in what you guys believe you can move in and out of, and have no limitations on how much you want to hold with a tokenized asset from, let's say, JP Morgan, some bank, right?
Yeah. I mean, I think from people coming from a TradFi perspective might feel more comfortable with a tokenized deposit product because it's sort of on a firmer regulatory footing. It's the banking system. It has prudential regulation, capital requirements. But from our perspective as like a DeFi protocol, very crypto native, it actually is sort of less digestible, less appealing for us than stablecoin products, which are a bit more up in the air of like how they're handled, but they have strong acceptance, and the way that they're backed is for us it's lower risk.
Yeah. I want to make a quick comment on this question. So often I get asked who's gonna win, right? They kind of put these three words in competition and say, hey, which one's better? Oh, stablecoin's better than tokenized deposit because it's fully backed, or tokenized money market fund is not as good because it can't move around. But when you think about it, actually that question itself is misleading, right? When you look at tokenized money market fund, it is a security. It's not money, right? It is fulfilling an investment use case. People use it for cash management, right? It's managed by professionals to rebalance treasury assets, right? So it is an instrument that's not designed for use as money, right? For payment. So that's where we always use the terms money at rest, money in motion, right? So I think that there's actually so much synergy between the amongst these three, right? So when you look at tokenized money market funds that can use stable coins for in and out, right? And then the stablecoin can use money market fund to fulfill the reserve portion, to also outsource the portfolio management component to the professionals, right? So then the builders of stablecoin can actually focus on the scaling of the stablecoin solution itself to get users to optimize the product feature of the stablecoin without struggling with portfolio management that Fidelity should do, for example. So I just wanted to quickly add on top of that.
Yeah, that's a great point. Otto, you have been sitting in DTCC, which is settling trillions, right? And so this, while I said the tokenized market is 30 billion, that sounds like a lot. Like that's like peanuts to what you're seeing. So what's your thoughts on this cash leg on chain and what that looks like?
Well, fortunately, we have reached the quadrillions in the settlement and the clear, but what I love about this subject is that it's taking us, if we pay attention, back to the basics of economics, right? It's really the use of money, the value of money, and what we use the money for, what we consider money. And let's remember that at the beginning of the whole economy, or economic concepts, the money was based on the liquidity and acceptance, right? And the use case, of course. People that will use money to save value was different use case and a different structure than the people that was using it for payment or for mean of exchange, right? So the comparison that we're making here between the three types of stable coins, the tokenized deposits and CBDCs, is precisely that. Where are we putting our faith on the value management of that currency, right? And what are we using it for? Like you were saying, I don't think there's a competition. What we need to focus is in who is controlling that, or who are we placing the faith at the end of the day of controlling that value, right? If it is a bank, yes, we trust in professionals and everything is, but it's human error at the end of the day. There's operational process, technology, there's many risks that can go into that. If we put it in the central government, history has proven that sooner or later, it will end up in inflation or with some sort of monetary manipulation, let's say, right? Whether it's policy, whatever, it might be good for the country, but there is a power of decision on our value and use of that currency. And if we keep it to ourselves as a stable coins that eventually we will have to run into self-custody and really understanding what is it, then it comes to what is it pegged. At the end of the day, this is a pegged currency, and we have had pegged models before, right? So are we paying it to the dollar? It's the same thing as a CBDC. At the end of the day, who issues the dollar? If we're paying it to a smart contract or to an algorithm, who manages that algorithm and what is it serving? What strategy, what purpose, right? So I think it's really, I don't think there should be a competition. What I like about free markets is that you can understand your risks and use it for the best way you can use it, right? In the transactions or type of economic activity that you want to do. Investment managers may trust or rely more in a tokenized deposit because of the banks that are behind it. But people that is using it for investment, they might want to look into more options, including the one that is more liquid, which is the most acceptable. So coming back to your original question of what is the main bottleneck, is really what is the level of acceptance. Who is accepting stablecoin and which one? That's what's going to rule at the end of the day which one is more adopted, I think.
Simon, any thoughts?
Yeah, I was thinking I was thinking back to this. It's a good question. I don't think it's a zero-sum game. I don't think one wins, the other one doesn't. I think you can equate a stable coin to a dollar bill, and you can stable a money market fund on-chain to a money market fund off-chain. I think it gets super cool when you can settle in assets that are instantly yielding interest, right? And I know it's a different regulatory oversight, but if you're buying stuff on chain and you can settle with a fund like USTB where you know the price is exactly where it is every block, and as soon as it's in my wallet, I'm earning interest, and the second I send that over to my OTC counterparty, they are now earning interest. They don't have to go from being on-chain stablecoins, off-chain money market funds and take a 2-day data round. The second it hits their account, they start earning interest. I think that's a really cool proposition. And then ultimately, why not, when I go to Starbucks, I tap and pay, and I'm earning interest on my money until I give it to them, and then they're interested on their money the second I pay for it. I think it makes sense, and I know I'm blurring boundaries between stablecoins and money market funds, but ultimately we could end up there.
But let's keep in mind that lower risk means lower returns, right? That is by law. So we have to find where is the return coming from. I think now is shifting to more operational and technology risk that we need to understand. But those gains that you're saying are going to have trade-offs, right? In terms of the returns of the portfolios, in terms of many other components.
For sure, but we're competing with zero at the moment on returns. So
I
it's not
also
gonna be hard
wanted
to
to double click on that, right? So when you mentioned that someone has a wallet, has stablecoin, it should be like automatically yield bearing. But when you think about all of us holding a brokerage account, the cash in your brokerage account are actually in money market fund automatically. You don't have to opt in, right? Like you don't have to do another set of paperwork to sign up for a money market fund. It's already in there, and it's like effortless, right? Well, we want that to be in the wallet structure as well, but what are the gaps? Why we can't do it as of today, right? So think about the largest treasury fund managers. They usually distribute through banks and broker dealers. There's set pathway to do that. The banks and broker dealers does the KYC. They said, okay, we know these people, we do the bookkeeping. But in the on-chain world, that model has not been built. So then you rely on the issuers, the fund managers, to individually onboard every user. So I would say years ago, a couple years ago, you see this huge uptick of adoption in tokenized treasury. It is because all these emerging market retail users are willing to get on these rails because the stake is high for them. They need US denominated assets. They want higher interest rate. They're motivated, right? But when you look at the US users, they're less motivated because they have easier access to treasury assets. Instead of downloading another app and filling out the paperwork, upload your ID, why would you want to do that for $2 of yield, right? So I think that eventually you would see, maybe it takes fundamental regulatory progress to some extent, right? So right now the rules and regulations are still pretty much tailored for a more centralized model, right? So when you push the asset issuers to know every user, and if that's what it takes, of course, then you build adapters and you have multiple layers of manual work that's off-chain that will create friction. So I tell people that these frictions are not Web3 problems. However, these are the necessary Web2 adapters that we have to live with as of today.
The main limitation is finality, is what the previous panel was discussing at the end, right? It's where do you consider your settlement to be recorded? And until regulation allows the blockchain to be the actual book of records, right, there's going to be all these limitations and troubles because we have to confide in where is it that the value that I'm accounting as my investment or my worth is being reflected, right? And when we have options of chains, options of transactions, it's going to be hard to reconcile, especially if we still keep a leg on the pure cash. So I think one of the objectives that the industry has to have is to move towards a single concept of finality and how to treat it and where to treat it with the technology that we're facing, because it's not going to be a way. So.
Yeah, listen, I think that's 100% right. I think you can have netting and finality and it works. And having worked on a trading desk for like 12 years, you realize that we've come a long way from noting stuff down in a blotter and consolidating at the end of the day. And then equally, if someone made a mistake and you're trading against, if you're at UBS and you made a mistake against Goldman Sachs, then you pull the tapes, you pull that, you look at a Bloomberg, and you reverse the transaction. I kind of feel like that might be part of the narrative as well, right? You net stuff down, you finish the transaction, you get all the upside of the cost savings and the stripping out middle and back office functionality. And then if someone's made a mistake, which there'll still be humans involved at some capacity and still be human error, then that gets reversed, right? And but you can only do that with well-known counterparties that you're documented with ISDAs and CSAs and all that kind of stuff. But I think that's where we end up institutionally sooner rather than later.
Yeah, that's a good segue into netting and how does that fit into atomic settlement on chain. So kind of doubling down on what you just described, Simon, right now, and obviously this is your world, Otto, all the trades are settling through the front, middle, back office. And through that chain of kind of checkpoints, there could certainly be human error, right? But that's okay in some cases because humans have the time to correct those errors and reconcile it, and people don't necessarily lose money in most cases. If we're moving towards this kind of, instant settlement, atomic settlement on chain for these securities, we can do this easily with crypto native assets, but, is that really possible? And if it is, why? I would love to hear why do you guys think so? And maybe Monet, if you want to start, do you see a future on chain where tokenized assets can have instant settlement?
Yeah, I mean, so Spark is, a DeFi native protocol, so we're very comfortable with atomic settlements. Our business started basically lending permissionless stablecoins like DAI against permissionless collateral assets like ETH. So that's kind of where we are most comfortable. I think that it's like was mentioned, it relies on regulation kind of catching up and making sure that the tokenized representation of an asset actually is legally where the title and like the ownership of the asset sits. But I expect that once we have that regulatory system develop a little bit more, we'll be able to have a lot more assurance that like we can provide a stablecoin atomically against a tokenized fund, and we're not going to be at risk of it rolling back. And when you have like a trusted counterparty relationship, you can still build netting and sort of like delayed settlement on top of that, and just kind of look at like the stablecoin transfers as like the sort of more efficient, always-on equivalent of Fedwire or something like this. But the fact that you have this globally accessible sort of real-time gross settlement system that's very efficient, available, means that you can also have trading relationships, counterparty relationships with people that you don't trust, you would never be willing to have delayed settlement with, but you can still have an economic relationship with them based on kind of like a real-time gross settlement style of system, which I think expands the types of economic activity that can take place efficiently.
I probably wouldn't add much to that, and I really want to hear Otto's opinion because he's a better place to talk about this than I am. So I hear what you have to say first.
Well, first, definitely, we believe in so. Otherwise, we will not be moving to that in that direction, right? The thing is, I don't think the risk is eliminated completely. It's shifted, as I mentioned before, to an earlier stage in the process, right? Now, the programmability of assets, what it allows you is to keep it standardized. Instead of having random events of risk or random events of where the security didn't settle or didn't process because of a human error, you have programmability that will standardize all that. Now, that requires attention to the detail in how you're programming those assets, how are you designing the processes, the smart contracts, the auditors of the smart contracts. It is at the beginning. So we have to be just more proactive and more, let's say, smarter in terms of how we are dealing with the information. And this is something that we cover in the last white paper that we published with Clearstream and Euroclear. The precision in the processes, right? The attention to the access of data, the standardization of those processes. That's what's going to enable us to really adopt a settlement with atomic settlement across the board, but it requires design. Programmable assets are designed assets, right? So if we can do that, definitely this is possible.
Yeah, and I think, there is a opportunity now to kind of like start from scratch in establishing those standardizations, but still doing that carefully. Once you are on chain, you would have to trust the entire system has those same kind of, risk, controls, right? So you can get an asset on chain and you could have done your due diligence on that chain and know the counterparties, but if it's going to be composable and interoperable, like how do you really make that whole wide universe
Well,
secure?
I think one of the beauties of tokenization is that the asset doesn't depend on the rails anymore. The rails are in the asset. Let's remember that interoperability, liquidity become an attribute of the asset, not of the blockchain, right? So as long as you design and you really understand what is the process and the logics and the patterns that you will have that asset to perform, that's the exercise. That's what we need to have our brains put on. And then it doesn't matter really what rail you are. You can be in any blockchain, any L1 or whatever. If the asset is well structured and well programmed, it will function.
So in the case, I guess, Monet, I'll let you maybe take this topic. And sorry, you are like the DeFi hack expert on the floor here, but with Otto's point of if everything is kind of programmed into the tokenized asset, right, and that's kind of where the risk is managed, there still are incidents if that asset is being used as collateral, there could be a key management exploit, right? So even though the token itself could be like bulletproof in its like design, you still can't control these externalities of key management, exploits.
Yeah, I think it's, it's an interesting challenge because, to date, like I think the key sort of like horizon or like separation has been between the off-chain systems where real-world assets are being kind of like held, recorded, and then blockchains. So there's kind of like a barrier there where different sides of it can like have a settlement failure or something like this, and it's not actually atomically like payment versus payment settling. If we move more of these RWAs to use, programmable tokenization on chain, but the rules of how that programming works is not, it's heterogeneous across different RWAs, different issuers, or maybe considering a trade of like a tokenized fund versus a permissionless asset like ETH. You still end up having that sort of like barrier where like the different legs of this trade are not settling under the exact same rules, so you can have them kind of diverge a bit. So yeah, I think it is going to be a significant challenge. With that being said, I think a lot of the we've seen a lot of hack activity in DeFi in the past few months. Hundreds of millions lost, but what we're seeing is that less and less of these losses are resulting from code bugs and the actual smart contracts being faulty. It's more just key management or custody issues, which it actually makes me very, I have growing confidence that we are gonna be able to create bug-free code to run these assets, and then if we can bring in more professionalism on the custody side, which I think the crypto industry somewhat lacks so far, but there's a lot of really qualified professionals coming in who are very, very strong in this regard. I think we'll be able to have an ecosystem that has less of these faults happening.
And I'd add one more point of security in this situation, that Superstate assets are permissioned, so it can go into permissionless pools, but they're permissioned as in there's what's called an allowed list. So only people who have KYC'd and AML'd with us or through a third-party provider can then hold these assets. They whitelist a Solana wallet or Ethereum wallet. And then if you try and send this asset outside of that allowed list, which can include smart contracts, that transaction just gets decayed. It doesn't happen, right? So there's no point hacking Superstate, and there's no point sort of trying to send assets or hacking the pool and sending Superstate assets anywhere else, because it's just not going to happen. And then we can just burn those tokens anyway and send them back to where they should be.
So one example where I think there might still be some risk. So let's say that you are a whitelisted user on Superstate, and you let your private key get hacked, so somebody has access to your tokenized funds. They can post that as collateral on a DeFi lending market, and then exfiltrate some permissionless assets that can't be clawed back. So I think there continue to be some risk factors there, and then who holds the loss in that situation? Is it the DeFi lending market that's allowing you to margin these tokenized assets and not checking if they were the proceeds of a theft or crime? So I think there's still some challenges, but it's definitely a significant improvement versus just DeFi Wild West, no rules situation.
Jasmine, do you hear coming from any of your kind of customer segments concerns about DeFi hacks? So when something happens, do you get pinged by either peers that aren't working on the tokenization part of the Fidelity business?
Yeah, of course, a lot of them. So I would say we always are fascinated by these financial pyramids, especially for a structure like a vault, right? So that create possibility for asset managers to create native portfolio on chain, which will solve a lot of problems, because right now the portfolio is managed off-chain in either private fund structure or registered investment fund structure, but then you constantly still have to do the on-ramp, off-ramp. Sure, as more solutions get built, that's getting easier. However, it won't change the round-trip model that's going to be inconvenient, right? If the portfolio is on-chain, then you don't have to do this round trip. I always use an analogy. It's okay, right now I'm an asset manager. I want to cook a meal on chain. However, I don't have enough ingredients also today to make a decent meal. But once there's enough tokenized assets there, then it would we would do it, right? So that's another hurdle. I know the original question is about whether or not we get questions, right? I wanted to mention this first so you know that I personally believe in the concept. I think it's gonna create so much possibilities for our industry. And I think my peers with this background that feeling positive about the development and the future, and then they hear about these hacks, then I would say it wouldn't automatically put people think, okay, these are nonsense, we won't look at it again. It is more like, okay, what are the risks? Is it security risk, like a smart contract risk, or like what's the problem, right? That help us to think through how we should build solutions with these risk factors considered. In a way, it is a stress test of the space, right? So, of course, it's very unfortunate that these instances happened, but it also kind of showed, okay, what could have gone wrong and what we could have done better, right? So I think that lessons learned is very critical. And then hopefully, eventually, we'll be able to do more real business on chain once those concerns are addressed. Yeah.
I think this is where the infrastructure really needs to be analyzed and discussed, right? Because after all, even if we move to DLT and Web3, we're still connected by a cloud. There is still a component there that is still public, it's still commonly used for many users and many cases in many actors. So what we need to understand is really the points of entry of that risk, right? I think wallets are key. Wallets have to really up their game in terms of implementing the different models of solutions for algorithmic threats, as well as for security and vaulting. Even if they don't intend to be custody wallets, there's certain custody infrastructure they need to guard because they will be managing, for example, the custody of the right of control of a function, right? Even if it is not a key. The cloud, the connectivity to the cloud will still have to connect APIs through APIs to connect via the data. So there's still components in infrastructure that have to evolve as quickly as they have in terms of programmability. But definitely it's going to get there. I'm trustful on that.
We have a couple more minutes left. I guess, Otto, to kind of touch on that point more broadly. So with DTCC and they're kind of building into on-chain rails, is the driver more on the 24/7 enablement of trading and settlement? What is kind of the vision, or is it something else? I mean, it could be a mixture of both, but is it high level? Why did you, I think, what was it, a couple years ago, get tapped, or it was your idea, say, like, we should be working on this and moving in this direction?
Our role as an FMI, right, is to provide infrastructure to reduce risk or to better manage risk. Among that risk, liquidity, of course, which is settled by less time, more efficiency in the settlement. But ultimately, it's also the interoperability and the interuse of assets, right? We know the problems and the cost that it has for an economy to have huge amounts of fixed income, for example, sitting in one leg and equity on the other one, and not being able to use it either way, either for collateral purposes or for transaction purposes or for return. So I think ultimately one of the biggest efficiencies that we're seeing is the reduction in the risk of transferring your operations from one asset to the other. Assets ultimately could become interoperable and interchangeable, right? If we can provide that security that, trading, all the other commercial and financial activities will take place with more flexibility and more liquidity as well, right? So.
Okay, awesome. I guess final comments, real quickly. If everybody could go through, what have you changed your opinion about crypto in the last 2 years? Is there something regarding risk, what it can do, what it can't do? I know that's a bit broad, but what do you want to go first?
Yeah, I guess I've warmed up to tokenized assets. So I came into the space originally just like really gung-ho, like every asset needs to be permissionless. If it's backed off chain, it's not real. And yeah, I mean, I think like the level of robustness that we're seeing with stablecoins improving, new classes of tokenized assets having like really strong levels of disclosure is very encouraging. So like I think it's something that even as like a DeFi native person, I'm getting more confident.
Yeah, and I think we've seen a few stellar use cases of the blockchain technology over the last couple of years, and I think that's prompted institutions to really come at it hard and really get involved, and that's been great because maybe prior to that, I'm like, okay, is this just a silly thing that's happening and no one really cares? I think people care now.
I've changed my mind with open source. I used to be very aversive about open source, but I've learned that it's the only way to really test whether your programmability functions or not, or is strong or not. And just like in real estate, this is location, location, location. I call it here test, test, test. You have to test your assets to make sure that they're working correctly.
Yeah, I wanted to mention something around like which asset classes need to be tokenized to make it useful, right? I kind of flip-flop between the two barbells. I was okay. Initially, we started with illiquid. I was okay. It makes so much sense. The operational efficiency of real estate or collectibles and etc. And then it was like. Of course, it didn't really work well and had adoption. Then we went to the most liquid side of stablecoin, treasury assets. And then now I kind of flip back and say, okay, maybe it is very interesting for private market as long as it's done right, because just the price discovery mechanism that blockchain market, on-chain markets can do is very valuable.
And probably the yield has something to do with it too, but that's a different panel. Yeah. All right, this is awesome. Thank you guys so much.